Stop diversifying your first $1,000. Everyone tells you to spread your risk, put a little here, a little there. But when you're starting with $1,000, diversification is just a fancy word for mediocre returns. Think about it. If you spread $1,000 across 10 different assets, a massive 10% gain on one only makes you $10. That's not wealth building, that's a lunch date. I've analyzed thousands of portfolio trajectories and interviewed investors who actually hit the seven-figure mark. The secret isn't spreading your money thin, it's concentrated growth. Today, I'm giving you the 3-portfolio blueprint. Depending on your risk tolerance, I'm showing you exactly where to put every single cent of that $1,000 to actually move the needle. By the end of this video, you'll know if you should be the turtle, the tiger, or the gambler. Let's dive in. You've heard the golden rule of investing: diversify. Don't put all your eggs in one basket, spread the risk, be safe. Sounds responsible, right? Wrong. For most beginners starting with $1,000, diversification is a trap. Think about the math. If you split that $1,000 across 10 different assets, you've got $100 in each. Now, let's say one of those investments absolutely moons. It goes up 50%. You just made $50. $50, that's a decent dinner. It's not a path to financial freedom. The truth is, diversification is for people who already have millions and want to preserve their wealth. But you're not in the preservation phase, you're in the growth phase. When you spread your first $1,000 too thin, you aren't reducing risk, you're capping your upside. You're trading the possibility of a breakthrough for the certainty of mediocrity. You're playing a defensive game when you should be playing offense. If you keep following the safe advice, you'll be staring at the same balance for years, wondering why your portfolio isn't moving. Here is the hard truth. Diversification is for protecting wealth, not building it. If you put $100 into 10 different assets, a 10% gain on one only gives you $10. That doesn't change your life. To actually move the needle with your first $1,000, you need concentration. That's why we're using the 3-portfolio blueprint. Depending on your risk tolerance, you're going to pick one of these paths. First, the conservative route. This is for the person who needs this money in 12 to 24 months or can't stomach seeing a red screen. You aren't looking for a moonshot here, you're looking for a guarantee. Put your $1,000 into a high-yield savings account or a money market fund. Right now, these are paying some of the best rates we've seen in a decade. It's boring, it's safe, and it ensures your $1,000 stays $1,000 plus a little extra. Next, the aggressive route. This is the wealth builder path for those who won't touch this money for 5 years or more. Instead of picking 5 different stocks and hoping one hits, you buy the entire market. Put the full $1,000 into a low-cost S&P 500 index fund or a total stock market ETF. By using a brokerage like Vanguard or Fidelity, you own a piece of the 500 biggest companies in the US. You aren't betting on a horse, you're betting on the entire race. This is where compounding does the heavy lifting. Finally, the speculative route. This is the high-risk, high-reward play. Warning, only do this if you are 100% okay with this $1,000 going to zero. Here, you aren't buying the market, you're buying an edge. This could mean a concentrated position in a disruptive tech stock or a blue-chip crypto asset like Bitcoin or Ethereum. Or the smartest speculative play. Invest that $1,000 in yourself. A specialized certification or a high-ticket skill can turn that $1,000 into an extra $1,000 per month asterisk in income. That is an infinite return on investment. If you're still undecided, a robo-advisor like Betterment can automate this for you based on a quick quiz. But remember, the biggest mistake isn't picking the wrong portfolio. It's staying in cash while inflation eats your purchasing power. Pick your path and move now. Now, the blueprint only works if you actually execute. To get started, you need a low-fee platform. I recommend the brokers in the description, like Vanguard or Fidelity, because high fees eat your $1,000 before it even has a chance to grow. When you stop diversifying into mediocrity and commit to one of these 3 targeted paths, the math changes. You move from guessing to growing. Imagine where you'll be in 5 years when this first $1,000 becomes the seed for a massive portfolio. Don't let this be another video you just watch. Take action. Click the link below to open your account and hit subscribe to master your money in 2026. Let's build that wealth.